So, you're ready to take the plunge and start investing your hard-earned dollars. It can be an exciting prospect to make your money work for you for a change. Anyone who is serious about building wealth and protecting assets against inflation should consider investing. But whether it's the stock market, real estate, or a startup company, it's serious business to hand over a portion of your paycheck. It can take years for a portfolio to recover from a few investments that could have been avoided in the first place. But worry no more! Hey guys, welcome back to the channel. And in this video, we're going to share with you some of the warning signs and red flags of a bad investment that you should avoid. These tips will help you to better evaluate the pros and cons of an investment the next time you go looking for returns on your capital. But before we start, please like the video and subscribe to the channel for more similar content like this. Now, let's begin. Promises of high returns. The most common of all investment warning signs is the promise of returns that are too good to be true. In fact, promising returns that are any higher than bond yields or current interest rates is a red flag. High-pressure sales tactics or promises of returns that will make you rich are a sure sign of an investment scam. All investments carry some level of risk, which means you may lose some money. That means returns cannot be guaranteed or promised. Only a government can guarantee returns, and there are even limits to that. Legitimate asset management companies explain their investment strategies and may have a benchmark that they aim to beat. One of the reasons ETF investing has become so popular is that exchange-traded funds aim simply to earn what the benchmark index earns, and charge a small fee for doing so. Moving the goalposts. Another telltale sign of bad investments is that goals or benchmarks get moved when they're missed. This can happen when a financial advisor makes an investment recommendation that fails to perform. Rather than acknowledging the bad call, the advisor moves the goalposts by setting a new benchmark. Companies also do this when they repeatedly change strategy. Delayed redemptions. If withdrawals from any financial product provider take longer than reasonable or promised, there may be a problem. This is very common with unregulated forex brokers or asset managers. It often occurs when client funds are not kept in segregated accounts and are used for business expenses. It's also a potential sign of a Ponzi scheme that uses new customer funds to pay redemptions. Redemptions from a fund may be suspended during periods of unprecedented market volatility, but they should not be suspended under normal market conditions. No third party involved in administration of assets. Legitimate asset management companies typically involve a third-party administrator or custodian in the administration of assets. This means the asset manager does not have complete control of the client's assets and prevents investment fraud. Third-party compliance and auditors provide another safeguard against fraud. This doesn't mean the fund manager can't make bad investments, but the alarm may be raised if risk limits are breached. If a company has a single bank account and no external service providers, the likelihood of customer funds disappearing is much higher. Lack of liquidity. Typically, there are two ways for an investor to exit an investment. In the case of hedge funds, mutual funds, and segregated accounts, a redemption request is made. The fund manager then sells the securities and returns the cash to the investor. This situation is straightforward, and there should be no problems. In the case of listed instruments, including ETFs and company stock, the investment is sold in the open market. Provided there is an active market for the security, this will not be a problem either. Problems arise when there is no active market for the investment. This can occur with very small listed investments, but it's more likely to occur with OTC, over-the-counter shares, derivatives, and structured products. If there is no buyer, you will not be able to sell the investment. A sure sign of bad investments are OTC products where the seller is the only market maker or promises to buy the investment back when you want to sell it. Typically, you will receive a terrible price or pay a hefty commission when you exit. Dividend cut. A company reducing the size of its dividend is a sure sign that things are not going well. Companies set their payout ratio at a level they are fairly certain they can afford. If they must reduce the dividend, it means profits are under pressure, and things are not going according to plan. Earnings will probably come under pressure, and the lower yield will make the stock less attractive to investors. Both will probably lead to a much lower stock price. Stocks with high dividend yields may appear attractive to income investors. What really matters, though, is how sustainable the dividend yield is. A stock with a lower yield than the prevailing interest rates can turn into a good investment if the dividend is sustainable and grows gradually over time. This gives you the benefit of both compound interest and capital gains. Delayed release of results. If a company delays or postpones the release of its financial results, it will often mean bad news is on the way. It may also signal that the company's auditors are reluctant to sign off on the results. Either way, it's a potential early warning sign that the stock is a bad investment. Another red flag is when companies schedule their results for late on a Friday or the evening before a bank holiday. They do this in the hope that Wall Street analysts will miss the result and the market will have more time to digest bad news. These are all signs that there is a higher risk that the company is struggling. Changes in accounting policies. Occasionally, companies will change their accounting policy when they report. These changes can affect the way inventory and assets are valued, the timing of revenue recognition and accounting periods. Business units can also be reorganized and moved from one segment to another. These changes are then applied to historical results as well as the most recent period. There may be perfectly valid reasons for these changes, but reformatting the results is also a good way to hide problems. When prior periods are restated, current results may look better than they are. Changes in accounting policies are often followed by increased volatility for the stock price. Executive turnover. Company management can't be expected to stay at one company indefinitely, but when there is a string of executive departures from a listed company, things may not be going well. Senior management at listed companies are often incentivized with long-term share options. These options can become very valuable if the stock price rises. On the other hand, they will be worthless if the stock price falls or fails to appreciate. If executives don't think the stock price will rise, they may be better off moving to a different company with better prospects. This is just another sign of potential bad investments. Write-downs. Asset write-downs are often investment warning signs for stock market investors. When a company buys or owns overvalued assets, they are typically listed on the balance sheet as intangible assets. If it becomes apparent that the real value of these assets is much lower, their values will be written down. A write-down will reduce the value of the company's equity, and invariably the stock price will fall substantially. Write-downs often happen over several quarters, leading to prolonged volatility.